Corporate Finance Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to profit margin, a 2-year comparison. So we'll calculate the profit margin for 2 years and calculating and constructing components of the income statement on which profit margin is calculated. Get ready. It's time to take a stance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to put that into the worksheet on the right-hand side, into the blue area on the right-hand side. What we have in our information is going to be income statement accounts. We got income statement accounts for the first year, and then we'll do kind of like a projection, and we'll use some of our information here in order to create the profit margin on the second year. So let's first think about the profit margin for the first year. We'll then construct, in essence, our income statement for year 2, on which we will then calculate the profit margin once again on the second year 2 numbers. Okay, so the profit margin, you will recall, if we pull it from an income statement, we've seen it before just in terms of, floating numbers. Here's net income, here's sales, here's the actual income statement, top line sales or revenue, bottom line net income or income after taxes. So we're going to be taking the income after taxes, which could be net income, bottom line number, income statement. That's going to be equal to the $416.70, and then we have the sales top line. The top line revenue, sales, income, it could be called any of those names. That's going to be the $2,630,000. That's going to give us our profit margin. So we're going to say profit margin is going to be equal to up to the 416.0707 divided by the 2,630,000. We'll then format that cell to a percent, home tab number group formatting to a percent. I'll add a couple decimals. Once again, get used to the rounding, so it's not exactly 2 decimals out. So percent and added 2 decimals. Then we're going to think about some numbers over here to calculate the income statement where they told us that sales, we're going to predict, and you can think about prediction, right? Now that we're thinking about these profit margins, we might be thinking about how can we use some of these percentages to kind of project into the future or think about what might happen. Well, let's think about projections right now. So we're going to say, all right, well, what if sales increases by 11%? Also note that as we do some of these projections, it's really useful to keep practicing as we're doing when we work in these worksheets. Put these numbers out in a separate cell so that they can easily be changed. And once you change them, it'll change your projection. So in other words, you can easily go from sales increasing or decreasing by 11% to 12% by changing one number when you have properly formatted Excel worksheets. So just keep on practicing that format using formulas whenever possible, because that allows you to make these adjustments, which is very common when you're making decision-making processes. So we're going to say, all right, sales up top, we're going to say that it's going to increase by that 11%. Now, when you think about the increase, you could think about it this way. You got, all right, here's the sales here. It's going to increase by 11%. So here's the 11%. And I'm going to make that a percent. Home tab, numbers group, a percent. We can think about this as this number times the 11%. And then we'd have to add the increase. So the original number plus that. Or we can do it a little bit faster. And this, notice this is going to be the case, if you're calculating taxes on something that you're purchasing or something, you'll do a similar type of calculation or a tip that you're trying to say, well, it's an 11% tip, and then I'm going to have to add the actual amount that I owe in the first place. And then how much does that, right? So we could say, okay, let's do 1 plus the 11%, making that a percent, which would be 111%. And that'll take us right to the bottom line. This times that will be the 2,919,000. So we're going to do that calculation here. I'm going to do the same calculation here. I'm going to be picking up the sales number here times, and then I'm going to put brackets around this so I can say 1 plus this 11% closing up the brackets. Now this is useful because I want to be able to pick up this number. I don't want to just type in 111, because if I want to change this number down here, I'd like to say, well, what if it was 12 here? Then it'll change automatically if I can use a formula. So then we're going to say that we have the cost of goods sold. Let's just say this equals the cost of goods sold. Same thing, it increased by 120 or 22%. Therefore, 100% of what's currently in there, meaning this number, plus another 22%, can be calculated as the cost of goods sold times brackets, one bracket so far, 1 plus the 22% for the 122%, closing up the brackets. And there we have it. Similar process that we did over here to figure that. Then we're going to say that the gross profit then, one stop along the way on our income statement, is going to be equal to the revenue minus the cost of goods sold. Going to make that an underline here, home tab font underline. Then we're going to say the next item is going to be the selling and admin. So selling and admin, it says it's constant, so we're going to say that's the same, I suppose. I suppose that means it's the same, and that might well be the case because these might be more fixed costs. So we're saying, okay, what happens if the sales go up? You would think that the cost of goods sold would go up in a proportionate way if we sell inventory, because the profit margin or the gross profit, margin would be about the same. Selling and admin may be somewhat similar because possibly the bulk of selling and admin might be something fixed, like rent and salaries to the employees, which might be more fixed costs. So that might be the same. That we're going to say is the operating expenses then. So that's going to give us the operating. Let's do it this way. We're going to say this is the operating profit, which is going to be equal to the 918.5 minus the 312. That's going to be the 606. Then we're going to pick up the interest expense, which once again we're going to say is constant. We're going to assume we got the same loan out there. We're paying interest on it possibly. That's going to be the 57,000. So we're going to keep that constant, even though there was a change in the volume of sales up top. And that gets into fixed costs and variable costs, but we won't get too much into that. But you could see why, interest expense may stay constant even though the sales volume increases. It would increase cost of goods sold, you would think, if we sell things. Okay, and then the next item being the income before taxes. So income before taxes is going to be equal to the last stop, the operating profit minus the interest income. So now we've got income before taxes on which we're going to calculate the taxes, which we're going to say are 33%. Therefore, I'm going to say equal to the 549.5 times the 33% tax rate. And notice I'm picking up these numbers as much as possible from over here. We're going to be working with our formulas as much as possible. That gives us our income after taxes for the second year, which we are saying is going to be equal to the 549.5 minus the taxes, which is going to be the 165. Okay, so now let's calculate the profit margin for the second year, profit margin year 2. Same calculation. It's going to be the income after taxes divided by the sales. So bottom line divided by the top line. And we're going to say this will equal then the bottom line and the top line. And that's going to give us our profit margin, which will be equal to this item, income before taxes divided by the sales. Let's go ahead and make that a percent. Home tab numbers, we're going to make it a percent. Add some decimals. Again, it's not even, but we're going to take it out to 2 decimals here. Let's put an underline on this one. Let's put a double underline on that one. Let's do the same up top. Double underline here, single underline there. Okay, so notice the profit margin percent here has gone down, meaning up top for every dollar of sales we had on the year 1 income statement, we walked away with about 16 cents, we could say. And here, for every dollar, we're walking away with like 12 cents instead of the 16. Now, why is that the case? Well, the major thing is here we got an increase in the sales of 11%, but the cost of goods sold increased by 22%. Now, why would that be? You would think that those would be kind of constant because the sales, if we sell things in order to sell them, the margin between those two, you would think would be the same. So in other words, you would think they would go up. If one went up at 11%, the other might go up at a similar rate. Now, it could be that the sales are going up and it's costing more because we're purchasing better items. We're selling better stuff, right? So the cost of the items that we're selling are better, so that we're selling stuff that maybe costs more either to make or to buy, and then we're selling them for the 11% increase. So sales then increasing by 11%. Obviously, there's two things that could be involved here if we're selling things. If the sales went up, either we sold more volume, we sold more items, more units, or we increased the price. So we could then break this down if we were doing more analysis on this and say, okay, how did this go up? Was it the volume of it? Did we sell more items? Or was it the price and then the cost of goods sold? We can break that down into its components as well. If there's an increase, is it that we sold more items once again? Or is it the cost of the items that we're doing that are increasing? And what's the effect on the flow? Are we using a first in, first out flow, last in, first out? So we could start to break down these numbers further into further components once we get the initial breakdown here of the analysis, and then get a better story as to what is going on and better idea as to what the decision-making process should be going forward.